Trading options could be daunting, especially for those of you who are just starting out. Wouldn't you be interested in hearing about the past experiences of some industry experts? Today, I speak with Claude Cyr, chartered financial analyst, trading instructor at the Prosperity Club, and former Montreal Options Exchange executive. Claude will help demystify common option trading myths and some common mistakes for beginners. Claude, welcome.
Thank you, Ryan. Good to see you, and thanks for having me.
No, it's a pleasure having you. Thanks so much for joining us today. Claude, I've heard you speak very passionately about your two mottos, that you believe that these mottos can help with an investor's trading success. What are these mottos? And tell us a little bit about each of them.
Yes, every time I teach, that's what I start with. So the first one is process before profit, and the second one is risk before reward. So the process before profit, because trading is really a question about having a process and repeating the process over and over again, and that's what makes the big difference between a pro and a beginner. Is the pro is really into the process, and you got to love the process. So it's like playing a game. Like when you play chess, you decide on an opening, a mid game, and a closing tactics. The same thing. So it's a process that you need to repeat. And the second thing is risk before reward, is because we tend to focus on how much money we can make instead of the real question is how much money can you lose, and you can't afford to lose anything because capital is everything. So that's why I really like them.
So what you're saying, though, is that you believe the psychological aspect is an important factor. So with this in mind, where should beginner investors begin?
Yeah, so I have a graph here that shows human nature when it comes to the market. And it's something that we've seen over and over again, where the market starts very low and you got only the smart money coming in, and then the institution gets in, and then the media gets onto the market and it's get people excited, and boom, you get the retail investors joining and then overshooting the real value of the market. And that's something that is really scary, because you can basically take this graph and put it one on top of another over the history of the world and all the big bubbles, whether it's the tulip, whether it's the uh, the uh, the South Sea Company, the 1930, 1987, all of them, they're all the same. And so it's really important for people to understand who they are as humans in order to get away from those bad habits of buying high and selling low.
Now, tell me a little bit more about those human behaviors. Are these human behaviors only occurring around major market tops?
No, actually, it's over and over and over again. This time is not different. We're somewhere on the way to the top, and after the top, it's going to come down. There's going to be a bull trap where people are going to go, oh, it's we're coming back to where the how it was. No, it's not going to be like that, and we're going to eventually go down, probably lower than we were before. And if you take that chart on the other page, I put two of them together, but you can actually put like 20 of them at one end of another, and the same behavior. You can start from the late 1800 on an old charts, and you can actually see this repeating over and over again. Human beings don't learn very well, unfortunately, and that's why. So no, sorry, Daniel Crosby, yes, said in the Behavioral Investor, and I like to quote him saying that your brain is outdated, impatient, and hungry.
So you mentioned that the brain is outdated, or Danielle mentioned that the brain is outdated, impatient, and hungry. That's a bold statement to make. So what are the ramifications of this?
Yeah, that's not fun to hear. And actually, if you think of your brain, it was formed about 40,000 years ago, in a very different environment than we are now. And it actually stopped growing when we discovered agriculture, because we became a one trick monkey, and then just repeated the same thing, didn't learn all these new things we needed to learn. We improved, but not that much. And it's going to take years for us to get used to concept like um, compound interest. A compound interest in our brain. I'll show you an example later on that is like stunning. Like it shows that we don't understand that, and other stuff like our brain is impatient, and it's impatient also because it's hungry. So it uses 25% of the energy that your body produce. So as soon as it can go into idle mode, it can take a pause. It will. So it's going to jump to conclusion. And I got a good example here. You got and it comes from a book called Think Fast, Think Slow, and think about a ball and a baseball. So a ball and a bat. Sorry, the bat is $1 more than the ball. Together, they're $1.10. How much is the bat? And the average person will answer that the ball is 10 cents. But no, because if you go 10 cents plus a dollar, that's $1.10 plus 10 cents, that's $1.20. The answer is is 5 cents for the ball, $1.05 for the bat. And that's together, that's $1.10. And that shortcut that we took is even more, I would say, scary, thinking that, if you went through the process of getting a college degree, or in my case a CFA, you know how important it is to verify your answers. We won't. So human beings don't double check themselves most of the time, and it's so crucial, because that's a typical mistakes. Everybody answers 10 cents and say, yeah, that has to be it, and don't even verify. So that's very, very scary for me.
Yeah, that is kind of scary. So you're establishing that we're very poor at understanding compound interest. Now, why would you talk about this in a presentation about options and beginners? Hopefully, you have some solutions for us, right?
Yeah, so let me give you the compound interest example. So I'll borrow $100 from you at 4% interest, right? So $100, 4% daily interest. So every day I'm going to give you $4 plus, and then it's going to compound. So how much do I owe you after 30 days, 60 days, 120 days, or a full year, 365 days? Well, if I ask you that, and I'm not going to put you in a bad spot on camera here, but if I ask you that, you're going to go, okay, 30 days, I can pretty much figure it out. The answer is 324. 60 days, that's a little more than $1,000. I can get that. 120, you're going to start to have serious issue. It's $11,066. But if you go a full year, the answer is 164 million. So forget it. Like nobody's even close to that number. And I typically ask people, I said, why don't you just come up with a number, and then when they do, I said, multiply it by 20, and you're not even close. And I'm right most of the time. So it's really hard for people to come up with a real number. And so the ramification of that is what I mentioned before. We go for the home run instead of going for the having the little gain that adds up. So that's what you want as a trader. You want those little gains that add up slowly, and then how you become rich is by growing your capital, and it's not by hitting a home run every 5 years. And yes, home runs are great, but they're very dangerous. And if you're wrong, they typically very costly.
Yeah, so let's get into some more of those mistakes, those common mistakes that options traders should avoid. I know that you have some solutions as well, right?
Yeah. So the thing is, the bottom line, and we don't like to hear that, but human beings are make very, very poor traders. So one thing we do is we tend to cut our profit very, very short, and take our and drags our losses forever. And there's a saying that says that a amateur loses money by taking too large losses, but actually pros lose money by taking too small gains. So, and it's something that you have to combat all your career. The second thing is we try to maximize the amount of time we are right instead of the returns. What do I mean by that? Is for people, it's very, very important to be right when they trade, and not really if they make money. So that's very, and some people, less scrupulous people, are taking advantage of this weakness by selling program um, like credit call and put spread, where they promise you they're gonna be right like 95% of the time. Yeah, but 95 times in a row you're gonna make 25 cents, and the five time you're gonna lose $5. You're not gonna make money this way. Like, and they are the most expensive services on the internet. So be very careful about that. The second thing, it makes from people the covered call, and I'm not saying a covered call is a bad strategy, but it makes it very appealing to the human brain and it's an easy way for people. And it's often how we use as professional when we try to get people to trade option with us. That's the first thing we sell. Why? Because it's kind of easy, and same thing because it increase the probability of you being right, not of you making more money. And that's the problem. And the last one, we have this thing about breaking even. Like we always come back to as soon. How many times did you hear people saying, "As soon as it comes back to where I paid, I'll get rid of it and I'll buy something that's going to go up." Why? Why this thing? Just get out of it now. And actually, most of my I have many systems that I use, so process that I put in place every day. Um, One of my favorite one. So my two favorite one I take every loss that I have, every position that I have in the morning, at night. Sorry, I get out, and the other one is every Friday. So every Monday morning when I show up, I'm all green. Like everything I own is at profit. And I love it. It's like the best position to be in. And as because the psychological side is so important, I'm protecting my capital and I'm protecting my ego and my joy of trading, my love of the game. And it's very, very important. So the solution for that are simple. So trading is about knowledge. It's about knowing yourself, learning these bias that we have, fallacies that are so called, and once you learn about them, is recognizing as they come to you, because they will always do. I made terrible mistake this morning, like horrible, and what did I learn from it? Nothing. Something I knew, and I just did it again. And so, but now I know what it is, and I can't panic. It's just okay. It's the past. It happens to me every 6 months, and I do something stupid. But now it's gonna pass. And the second thing is your trading should be mostly rule based. So the rules are should be set up ahead of you doing a trade. You should know what's going to happen in all occasion, not going by your guts, because your gut is going to do the wrong thing. It's about knowledge. It's your brain that knows what to do. If you learn how to do, if you spend the time watching videos like this because you want to learn, well, start by learning about yourself. What are the wrong things you're going to do next time you have a chance to take a profit? It's very important.
I guess no matter how much you talk about it, I still think about that home run. What's so wrong about going for that home run? You only need to score one big shot, right?
Yeah, yeah, I wish, and it does happen, right? So you're gonna have a few home run, and the more trades you have, more chances you're gonna make money, and but as long as you can keep those, right, and not lose a ton of money. And the problem is trading is not a sprint; it's a marathon, and so it's about getting that process and organize it and having a work ethic that's going to make it that you're going to repeat it, and over time you're going to make money, and once in a while you'll hit a mini home run, but you're not going for those big home run. And the reason for that is because that same slides, you guys all know about that. If you lose money, the amount of effort it takes to make it back is huge. So you should never, if you lose like 20% of your portfolio, you need to make 25% in order to make it back, right? And that's really hard. And so last year, a lot of people lost 30% of their portfolio. And they were lucky because the market came back, or lucky or good, and whatever it is, but the market came back. It could have not, right? And it came back because of the reaction of government, and a lot of people are saying all they're doing is pushing it forward. So if your portfolio is located, like in my career, what, 7 times I saw more than 30% loss. So if you lose 30%, you need to make almost 43% just to go back to where you were. And in trading, it's not that easy making 42%. So you should always focus on your capital. Capital is key. Yeah. So the big solutions are, first of all, learning to trade and learn money management. So don't skip, like I said earlier, the brains tend to skip part. Just go for it. Second thing is a rule of thumb: never lose more than 1% of your portfolio on one single trade. And people, when you say that, well, you're crazy. No, that's mathematical. It's been proven time and time again. Any large trader is going to tell you that's how it works. The thing is, 1% doesn't mean you have $10,000. You only invest $100. Is you can have a $3,000 position, but on it you cannot lose more than $100. So that's the amount of money you would lose. The other thing is, you have to learn to take a profit, and when and how, because that's the thing. It's one of the psychological effect of trading is we tend to fall in love with the trade that gives us great return, so we never get rid of them, and we have popcorn, like the trades that go really up and then they come back down and all this money is gone. So you have to learn to take profit, and obviously taking losses. The job of a trader is taking losses. And whether we like it or not, we're going to have more losers. Most people have more losers than winners. But those losers are going to be small losers, and the winners are going to be big winners. And that's how you actually grow capital. And, and that's the problem. So if you had to think of solution, um, it would be take the time to learn the platform. Don't be afraid to trade in a simulation environment. So most platforms offer you the ability to trade in a simulation environment. There's a lot to be learned by not losing real money, and that's where. So take your time. Um, Take your time to learn the option properly. You don't need to know everything about every Greeks, but you want to have some understanding on how they works if you're going to get involved with option. And again, so playing options is the best game. So I always say that basically when you trade stocks, it's like playing checkers. It's fun, but you have the options on it. It's like playing chess, and it's a lot more fun. I don't know the last time, Ryan, you played checkers, but unless you have young kids, I'm sure it's pretty rare. And then take the time to write your trading plan. And by writing a trading plan, you're going to know where you're going. So it's like a business. It's like opening up a shop. You're going to have an inventory of it. You're going to figure out the profit per inventory. You're going to figure out the hours you're going to trade. How much, when you're going to put things on sale because they're not moving fast enough and stuff like that. Everything should be in the plan. And then when you trade, write a journal. You're going to speed up your learning like you have no idea. Write down how you felt, because what you're trying to figure out is who am I as a human? What are my flaws? So you write down every trade and why you did it and how you exited and how you felt at the time. And then finally, take the time to plan each trade and trade the plan.
Yeah, I love all these items that you brought up. It's so many things to remember. If you had, Claude, to remember one and only one of the things, which one would you choose?
And you asked me if I just said a lot of things. You asked me if there one thing to remember. plan the trade and trade the plan. Don't get into something without a plan to exit, whether it goes well, bad, or it doesn't do anything. Because then you're going to rely on your emotion and you're guaranteed to lose.
Yeah, emotions in life, like in trading, are hard to depend on.
Yes.
So, Claude, let's get very specific to the mechanics of an option trade. What are some option trading mistakes that come up for beginners when they're placing their trades?
So that the first one is one that I struggled with. It's hard to put a stop when you buy an option. So one of the way people do that, when you say, let's say, I don't want to lose more than $1,000, what they'll do is they'll buy $1,000 worth of out of the money calls, and that's not necessarily the best way to profit from this. Um, the It might be a little better than keeping having more in the money and then just putting a stop somewhere. And I know it's hard in some option market to put an actual stop in the market, but some people do it, and it's doable. So let's say you buy something at $3, and then you say when it touches two, I'll get out of it. So that's one very hard one, and I think it's for everyone. I have yet to find the actual solution for this. Then we tend to keep low probability option as lottery ticket. And, if there's 50, 70, 100, and $125 in an option and you can still get it, like get out of it and take that money. It's going to pay your commission for a while. And so how many times do those lottery tickets actually pay? And my experience actually is not very good in that. So maybe someone is luckier on that side. We also used to only one strategy with options. So once you learn to do one trade and it works for you, it takes a long time for people when it stops working to actually switch. So a lot of people start with covered, right, and they'll do that forever, and they'll do that in a bull market where volatility is so low. It makes no sense to do that. Instead of being more flexible on what they do, we either also use option as speculative or income. But you could use them as protection. You can use them as a replacement. There's many other ways you can use that, and we have recency bias, and that's one of the reasons. Is we always remember where we were successful lately, and we think it's going to repeat, but no. So environment change, and we have to adapt. And as I mentioned earlier, we tend to go for the out of the money when we buy options. And what you do is you're paying very expensive for gamma, but you don't have a lot of delta, and that you'll make money if it goes in your way, but it's going to take a while, and sometimes the movement is not going to be as large as you think, and you're not going to profit from the movement. So sometimes it's better to buy more in the money, or sometimes a call spread, or starting with an option that's more at or in the money. So imagine you have a stock that's trading at $50, and your goal is going to go. It's going to go to 60, and so people will have a tendency to spend $1,000 on 54 calls. But the reality, if the stock goes from 50 to 54, you're probably not going to make a lot of money, if any, especially if it takes a while. Where if you had more in the money option, you will already be making money, and there would be ways to recuperate some of your investment. So again, so it's this concept of lottery ticket. So they seems cheaper, but they are cheaper for a reason, because their probability of success are much lower, and I see that a lot. Like people go for the out of the money instead of and what I see from a lot of professional trader are 70 delta. So people going for options that already have a delta of 70. So if the stock goes from 50 to 51, they will make 70 cents. And already if it goes from 51 to 52, they're going to make 72 cents now, 73, 75. And soon enough, for every dollar that the stock's going to go up, they will make $1. Where if you bought the 54 at 54, you're still making only 50 cents per dollar that it moves. So that's the big difference. And I understand it's really hard to to understand and to learn. So you need to live both of them. That's what I would suggest. Like if you ever in a situation like that, buy a call spread and buy a 54 and compare them and live the experience, and you'll see they're quite different.
So we have a lot of mistakes to avoid, and that's good. Any misconceptions about options that we should be aware of as well, Claude?
Yeah, the first one is you need a big account to trade options, and it is no so not true, and I find actually quite the opposite. People that don't have a lot of capital, I think would be better off trading options, not only because of the leverage and because of if you're buying an option, you're guaranteeing the amount of loss you're gonna have. I mentioned today a mistake that I did. The mistake was entering a trade I should have not, and for the wrong reason, but also I had slippage. So my stop was executed way lower than it was, and I had like a very much larger loss than I could have expected, like five times. And in option, that's not gonna happen. So if you have very small amount of capital, you can actually control pretty well how much money you're gonna lose. The second thing is you can only trade options in your margin account. That is not true. You can trade in registered account like RSP and TFSA, and they have rules like you cannot sell a put, you cannot just do call spread. Actually, you can't do. But there's certain things you can do, like covered right. You can do buying a put to protect your position. You can do. So that's something that people should take advantage of. And actually, they're pretty flexible when it comes to some strategies like the risk reverse and stuff like that. And the last thing is options are too dangerous for me. Options are a very high leverage instrument, but it only counts if you don't know how to manage your risk. So it goes back to my earlier statement. You should learn to manage risk, and by that I mean if you're calculating the amount of money you're gonna lose instead of calculating the amount of money you're gonna invest, it's gonna be very different, and your approach is gonna be very different. And then, therefore, once you know how option works, they're not more dangerous than any other product. To the contrary, they can be a lot less dangerous than just buying a stock.
Hmm. So we talked about a lot of things today, Claude. Did we miss to cover anything?
Um, my advice for people: just don't go at it alone. Like get help, find peers. There's options, meetup. I participate in a lot of them. There's TD education program, the one you're doing right now. That is great. Like there's so much knowledge. The option education days from the Montreal Exchange. And also, if you're gonna buy a service that teach you how to go at it, and not buy a service that tell you what to do. And that's very important. When I mentioned earlier some of the services that send you like buy this, sell that, that's not what you want to do, because you need to discover who are you as a trader, and only then can you actually really profit from it. So find systems that are going to teach you um, actually how to trade, and not just buy this and then you don't know their time horizon, you don't know where their stops are, you don't know how much money to invest in it. It's so dangerous.
All right. Great advice. Thank you so much. And for those in the live session, we now move on to questions.